All right. Okay, and we're live. So anything you say now will be recorded. So watch out, okay?
Yeah.
All right. So we are joined today by Silvia. Silvia, I've just, you know, took some assumptions. I figured she was Canadian, but she's not. But I found out a whole bunch of new things about Silvia. Not only is she one amazing financial advisor, is that correct? They say that your title correctly. Very
Yeah,
good.
yes.
She's a Spaniard without a Spanish accent, right? She's from Boston without a Boston accent. So I think I got that accurately. So Sylvia, tell us a lot more in-depth things about you.
Oh, Amir, well, thank you so much for having me. I know you and your company were speaking a little bit on Instagram, but so no, I'm not Canadian, but I do love Canadians. We were talking, Amir and I, earlier. And originally, so I was actually born in Spain and grew up most of my childhood in Europe. And I was working for all of these like European, Swiss banks and all the things. And my family was living in the US at the time. But basically, long story short, is after college, I went to work for Credit Suisse and I was working with ultra high net worth Mexican clients, like
Wow.
ultra. And we're talking 50 million and up. And most of like we had a $50 million minimum, and most of our clients had about at least like 300 to 400 million bucks, right? Just no big deal, just like
Oh
pocket
my God.
change.
No problem. Yeah.
Yeah. And so that was actually really fun as I was working there in Spain. I mean, in Switzerland, because it was like really nice. I was doing financial planning, I was doing a little bit of everything. And then I moved back to the US where my family was in Boston. That's
Mm,
probably why I don't have a Boston accent, because I live in Boston, but thank God I don't have a Boston accent. And I came back to Boston. I worked for Morgan Stanley,
very cool.
mostly with like the normal people, just doing financial planning. And then 3 years ago, almost 3 years ago, I started my own firm to really cater to younger demographics and to specifically being able to do more social media. I mean, the only reason why I left the firms like Morgan Stanley and Credit Suisse was because they did not let me do social media, or they wouldn't let me do something like this. So I was like, I can't live my life like this.
No, it's not possible because they cater to that kind of client, right? And and now and this is sort of a generational shift that's happening where that old money isn't really that old anymore, and it's definitely making a shift. Is that right? Am I seeing that right?
100%. Number one, the industry is mostly male dominated. I think the average age is like 60 or 65. So
That's
a lot of them are like, I'm getting the children now, right? Because it's like my parents have this financial advisor. He doesn't understand, like he talks to me in gibberish and financial gibberish,
stuff it.
and I don't. Right, I want someone young and fun and cool and like who gets me. And we're taking so much market share from these large banks because we just are on social media, and because and that's the thing, right? I think a lot of these like wealth management, they think that rich people are not on social media. That is like nothing further from the truth. And you probably know this, Amir, from real estate, but that's a huge misconception, is that a lot of the times, right, the wealthy are having their kids take on that money, and the kids are a lot smarter than their parents, and they know a lot more, and they do their research, and they want to make sure that they're having the best advice. And that's not something that used to be a problem. Like that's not something that most banks needed. So
Yeah, and that is not only a generational change. I think it has a lot to do with having those good old boys and girls take care of, mostly boys, I guess, old men taking care of all the money, and it's like the old school way of thinking of like what to do with it, and that shift is happening, and our generation is sort of like more conscious about what to do with it as well, and maybe, I don't know, maybe correct me if I'm wrong as we go forward, but I feel like we're a lot more clear-eyed, and we want to have more an impact on the people and our own environment around us. We're a lot more conscious. We're back in the day. I feel like it was more like, let's just make some money, right?
exactly, that's Amir. You could not be like more right. So it's actually it's interesting. I have, most of my clients are young, but some of my I have some older clients from like the past that came with me, and it's funny because the generation is so different. Like they're like, just make me money, I don't care. And then the young people, like especially this year, right? For example, this year with the war in the Ukraine, I was telling a lot of our clients, I was like, listen, oil is probably gonna go up, and defense is gonna go up. Defense spending is not going anywhere.
Yeah,
And I
that's
have so
unfortunate.
many clients, like over 50%, they were like, I don't want that. No
Yeah,
oil, no like arms, no guns, no nothing. And I'm like, but that's where the money is going. Like, and if you see
yeah,
this, yeah. So it's really interesting how the younger generation just, it's not about making money anymore. It's about putting the money where you find your values are like aligned with. And I know that's so cookie cutter and everyone says that, but it's really like, I want my money to go to the companies that do best. And I could argue, right, that there's some defense companies are protecting our country
yes,
against your missiles. But I think a lot of people have those like misconceptions, and they just don't want, even if it's gonna be what's working. Because I mean, oil is up 80% this year. They still are. I don't want to. Like, I'd rather have a lower return. So
yeah, and they're trying to be a lot more socially conscious, and that's great.
yeah.
So I just wanted to sort of introduce you more to the folks out there when we snip this up. It's you deal with all sorts of people with lots of money, little money, or what's your threshold?
Yeah, so right now we actually have, basically our company is we've kind of what's it called, segmented the market, where the people that we're managing money tend to be either already wealthy or up and coming wealthy. Like, you know, those business owners that are growing their firm and they're like they're like literally saving, 20 grand, 30 grand a month. That's the people that we manage the money. But then we do have another segment where we're for like our digital courses, where we're helping people get to where my business owner clients are. So I don't manage money for people that are just getting started anymore, because it doesn't really make sense for them to pay a management fee unless they're like very complicated. They're a business owner, they have all these things. So we have a courses for that, because it's a lot more simple. You just need to understand how to do it yourself, and then use technology to automate things. So I deal with a little bit of both, but in different segments. So I've seen it all.
Yeah, and you share a lot of your know-how and all the stuff you got on your head going on for free. So it's a lot of it's out there for people just to go and sort of watch, which is amazing. Thank you for doing that.
Yeah.
And I definitely appreciate it. And do you find that right now, at this point in time, a lot of people are thinking about, now's the time to do something. Now's the time to start getting into investing. Now's the time to kind of go against the current, where everybody else is more like preserved, and it's like, oh, I better put my stuff in a pillow somewhere and sleep on it. Where a lot of our generation is like, let's get rich in another way. Have you found that a lot?
Yeah, so it's actually funny. Most of my clients are women. I do work with men, but I feel like a lot of the women. This is something that's very common to women. We tend to be more conservative, right? Like a lot of men in general. I'm going to stereotype this, but what I've seen is with my male clients, it's more like there's just not as much patience, because I think money is so much more attached, especially to men. Like that's how men kind of, it's like my net worth is my self-worth, right? Whereas women, it's like, as long as she's pretty, like that's good. So I think women tend to have a little bit more patience with
Yes.
investing. And I think that's one of the reasons. So I have women being like, oh my God, the market's down, let's put more money, let's do it. Whereas like I've had male clients being like, we should sell, like I need to protect this. So it's super different how like the two mindsets work. But like, for example, the market's down 18% this year. Do I think we're gonna end the year down 18%? No.
No.
And no. And that's because it's very rare. Like the only time where we've ended the year down 20%, there was a financial collapse. Like a financial collapse. Like Lehman Brothers went bankrupt, JP Morgan had to save, like it was serious. Like this is nothing. We have some inflation, tech people are getting fired, but they're finding jobs right away because the job market is still very strong and everybody wants a software engineer.
That's right.
You know what I mean? So the job market is still very strong. Do I think it could spill a little bit? Yes. But I don't see the market in the year down 20% like it is right now. So
Yes.
I'm still like, I'm 70% invested. But a lot of my clients were like starting to put money to work, especially with the more cyclical companies, like, you know, the steel and chip sector, all the stuff that has underperformed for so long for the past 15 years. That's what we're trying to buy, because I don't think we're ever going to see tech, not for the foreseeable future. We're not going to see the crazy tech bubble that we've had last year, or meme stocks going up, or crypto. Like, it's all about boring, unsexy, and cyclical.
Exactly, and that's the like the meat and potatoes, right? So, I know you don't advise a lot of you know, people that are just sort of have a little bit of money put away, but they want to get into it. So, but I want to cover both spectrums in terms of like, how would you advise people right now? Let's say if somebody's you know, has amassed some money in real estate. Okay, let's start with that. They've amassed some money in real estate. What would you suggest they do? Would you suggest they stay in their lane, keep doing real estate stuff? Or would you say, hey, get out of it now and liquidate some stuff and get into stock market? What would you say there?
Okay, great point. So it depends, right? And it depends. Amir, like, I think like Toronto area is going to keep going up in real estate. Yeah, we could see some downside, but it's probably going to keep going up. You know, Ontario, Toronto, same with Boston, Beacon Hill, Back Bay. These are the top neighborhoods where we could see a little bit of a slowdown, but it's probably going to keep going up just simply because there's no demand. Like there's no supply. Like, there's so much demand, not enough supply. Yeah, interest rates are at 7% right now for mortgages, but that's not going to be forever. That's just transitory. It's the Federal Reserve is just trying to keep inflation down. So that's just going to be
sustainable.
Exactly. If you've been a successful real estate investor, you've made a lot of your money. There's one saying that it's like the wealthy make their money by focusing on one thing, and then they stay wealthy by diversifying. So I really do believe in that as well, right? Like, I don't do real estate investing because that's not that. My whole life I've been a stock investor, and I know that I can earn passive income with stocks, and I love it, and I like the liquidity of it. A lot of people don't like the stock market because they can't ride the roller coaster, right? They can't see the stock go up and down. And if I would say, number one, take a look at what market you're in, right? Are you in a primary market like Toronto, Ontario, Boston, San Francisco? I don't see New York even. I don't see that going down too much. Or are you in a secondary market where people have overbuilt? Like, if you look at, for example, a lot of secondary homes, at least in the United States, we've seen places in New Hampshire, Maine, the south of, where people go on to their second homes. I think those are definitely going to crash. So I would say, if you're in the secondary market, be careful, because a lot of this could spill, and then you might want to diversify. But if you're in a private market, you like real estate, you understand it, and you've done well, why do you want to change?
So you're on the same mindset sort of as Warren Buffett, who says, stick to one thing and don't just bounce around all the time.
Don't bounce around. And I see this people as like business owners as well, right? Like, when I've made the most money as a business owner is when I stick to one offer, one thing. I just do one thing correct and one thing right. And so I do believe in like the Warren Buffett, right? Warren Buffett never got into real estate. Everything he did was value investing in the stock market. That's all. That's all he did. And, and I'm in that belief too, where it's like, for me, I've thought about investing in real estate, but then I'm like, why are you going to learn something totally new where there's people that are way better at you than in real estate, who have a better edge, who have better connections. You have all the connections, you have the better edge on like this sector. So why change, right? And it's like, once you make your money and you have the ability to hire people that are professional in each area, then you can do that. But you don't have to. Got
it. And you don't know how many stock brokers and stock traders, day traders that I know that decide that all of a sudden they want to dabble in real estate because they got some money. And then, you know, and they don't understand the ups and downs of it because it takes a lot more time. So anyway,
And
it's
I mean, and I totally get it. People people only see the positive things in real
yeah,
estate or positive things in the stock market, right? And with real estate, people think that it's 100% passive, that you just sit down and you just collect the tenants' money. That is so further from the truth. I mean, you ask any real estate investor, like,
it's service industry. It's
right?
you have to service that property. You don't just like stick them in there. They're not robots and just sit around.
Exactly.
They're
And you
gonna
have to
break stuff.
yeah, and you have to take care of your tenants. You have to make sure that the lawn is cared well, like, because people talk, right? And if that tenant finds a better property somewhere else and they're not having a relationship with you as the property manager, like, they're gonna leave.
There goes your
And,
investment.
and another thing that I see with a lot of real estate investors, it's like they don't even run the numbers. They just like, oh, it's going up. Okay, I think it's gonna go up. And it's the same with stock investing. I see people being like, I'm just gonna buy crypto because I don't know anything, but I see
It feels good. My
yeah,
cousin's uncle's neighbor said it's great, and he made lots of money. So that's the rumor mill talking. So now let's talk something else. Cover a different spectrum. I'm an investor, sort of new, not me, but somebody, and they have anywhere from say $80,000 to $100,000, something like that, and just sort of getting started. They're giving you their money or your firm, and what would you do with it? What would you say they would put it?
Yeah. So right now we're about 70%. It depends, right? Are they a longer term investor? If they're in the longer term where it's like we're investing this money, I'll give you two examples. So I have a client who is more longer term because she's just saving for retirement.
Hmm.
That $100,000, I would keep buying stocks, every single week until I deploy that capital. And I would get diversified. I would buy value. I would not be buying growth or tech or things like that, because I think that's what's done really well the past 10 years. But we're in a different era. And now we have to understand that these tech stocks that went up so much last year, they're not going to continue. And now we have to go back to old economy, boring, the more unsexy, the better. That's the one thing. On the other hand, if it's someone that's like one of my younger clients, she's saving for a rental property.
Yes.
Because, people love rental properties.
Yes.
And I was like, okay, you're saving for a rental property. I'm only buying, if she wants to buy in the next year or two, there's no way I'm putting that money in the stock market. I'm only buying treasuries for her, right? I'm buying 8 month, and I just did a reel on this. I'm buying 6 month treasuries at 4.6%, 4.7, 4.6. If you can get guaranteed 4.6% with no risk, other than like the only risk is that number one, the stock market, like the US government defaults on their debt. And the second risk is if you want to sell before the 8 months are over or the 6 months are over, you will have a little bit of ups and downs. But usually US Treasury bills, like if you're really scared to invest, those are like where I would start. So I would do that for someone that is like looking for a short term, maybe rental property or wedding or something like that, or even taxes. Like I put all my money, it's my tax money that I need to pay in April or in March because I'm an S corp. I'm putting it all in treasury so I can at least get 4.5% while I'm waiting to pay my tax bill. But I don't put it into the stock market. So
Wow. Okay. And now, say if they're more into a long term kind of solution, something that's going to build them some like nice, robust wealth. What would you look at, and how would you advise them?
100% dividend growth investing. So right now, and I talk a lot about it in my Instagram, but if you actually look at companies that have not only paid a dividend, but have increased that dividend every single year or every few years for literally 50 years, and you compare that to companies that are like the get rich quick companies, like I would put like Okta or DocuSign, like these companies that have no earnings, that are like up and down crazy. They've actually the boring, unsexy companies have done better. So with my clients, I actually have like proprietary portfolios that I put people in, because I have not been able to find a portfolio manager to be able to have better risk adjusted returns. And I don't want to get too technical, but basically what I'm looking at is, number one, how long has this company paid a dividend? for, right? The longer, the better. But obviously, the longer, they're probably going to be a bigger company, so they're not going to grow as fast. The second thing is, what is the growth of that dividend? And a lot of the times, usually you'll see where if a company's paying lower dividends, they will have a higher growth rate. And sometimes that's actually better than having, a lot of people are like, love dividend yield, but that can be a trap. So I tend to focus on companies that not only pay dividends, but are growing their dividends and have at least paid them for 10 years. And that's usually what I put in people in. And that has a value tilt, which I think is going to outperform for the foreseeable 10 years.
Wow. And so now when we're talking long-term, what amount of time is that?
Long-term, usually anywhere more than 10 years.
10 years plus. Got it. Very similar to real estate when you're looking at a property investment where you buy the property, you're really not going to make a whole lot of money unless you luck out within the first couple of years, and the real money starts to come 10 years down the road.
Absolutely.
So that's very similar there. So let's say that we have some extra money, right? And I don't want to buy an investment property, but I want to invest in a company that invests in real estate properties. Is there such a thing where you would say, hey, this is a pretty cool idea, you should put your money in here? You don't want to do the maintenance and all that. You don't want to hire a company that takes care of that stuff. What do you think of that?
100%. And I personally own them because I like the passive income of real estate, but I don't like the maintenance. And I don't want to have to, even if I were to hire a property manager, I don't want to have to manage that person. So REITs, real estate investment trusts, companies like, for example, and I don't know Canadian companies, but there's two big companies in the United States. One of them is called Avalon, and the other one is called Equity Residential. Both of them, I have lived there. And they're great. They own so many apartment buildings all over the United States, and they will keep increasing their rent until and people, there's demand for it. And so what you can do is buy one of these companies, and they're required to pay out 90% of their profits in the form of like dividends or passive income, in order for them to be able to get like the tax like benefits and things like that. And so if you're someone, and I tell my clients this all the time, I'm like, if you really want to be a real estate investor, like go in and be a real estate investor, but you don't have to buy physical real estate to be able to reap the benefits. And so people are like, well, what about depreciation? Like, because everyone on Instagram is talking about depreciation, right? And I'm like, the companies that you're buying,
buzzwords.
Yeah, they're getting the depreciation benefit, and it's coming on to you. So I love REITs. Obviously, I wouldn't want to put all my money in REITs, but a little bit, 5 to 10%, I think it's great.
It's great to have that. And you've seen those companies steadily move upwards in terms of their assets and what they brought on?
Exactly. Yeah. And I've even lived in their properties. So when they raised my rent, right, Equity Residential decided to raise my rent from $2,700 to $3,800. And so at one time I could have been pissed. I could have been like, oh my God, they're raising my rent. But then I'm like, I left, I moved in with my boyfriend. And then I'm like, hell yeah, I'm going to be an equity investor in this company that raises rents by $1,000. Like, that's what you want as an investor, right? Like, you want a company that is really raising their rents in the market. And they were able to get someone into my apartment, 3 months before I left. So no vacancy. Like, they know what they're doing.
Exactly.
I'm not.
They live and breathe it, right? They live and breathe it every day. So now let's talk passive investment or passive income from investments, right? I know you've talked about that before. If you could clarify for folks that are out there thinking like, invest and then I still make money, how do I do that?
Yes. So I love, and this is something that a lot of people don't talk about because people want the get rich quick scheme that they see, the roller coaster. So when you buy a company, and not all companies pay dividends, but some companies, especially companies that are profitable, Caterpillar, Coca-Cola, Pepsi, who else? Northrop Grumman, like all these companies have been around for a long time, and they actually, a percentage of their profit, right? So they make sales, they pay their expenses, and then they have some profit. a percentage of their profits they actually give away to their investors.
Oh.
So they're basically kind of like paying you to be an investor in the company. And so one way, right? This is usually every quarter companies will pay their investors. And so what they'll do is they will you'll buy a company, and then, for example, I just got a notification, Northrop Grumman. It's a company that I own, and many of my clients own it. The clients that do like defense, but they pay a dividend of around like 1% or 2% of the value of the shares. And so as soon as you buy that company, as long as you hold it for a certain, it's usually as long as you hold it like during some time, some dates, you are entitled to a piece of the profits. So just by owning that company, even if it goes up and down, you're still earning that passive income. And I always tell my clients and my students and everybody, it's just like real estate. When you buy a house, right? You buy a house, you put a tenant in, that house is going to go up and down, except because real estate is so illiquid, you don't see it every day, like in the stock market. But that tenant, hopefully, if you put in a good tenant, they're paying you that passive income every single month. It's that thing in stock investing. So when you invest in a company, a lot of the times, right, they're going to split out every quarter some percent of the profits, and that's going to go into your checking account. And then you can either use it for fun, or you can just reinvest it and buy more shares of the company, which then gets you even more dividends. And that's how the snowball happens. So, yeah, a great example actually would be Target.
Okay.
So Target company.
Target didn't do too well here in Canada. So just saying, they opened up for a few weeks.
And then they've lent up. So
yeah, it wasn't even the Target stuff that you see. Like if you go to Target in the US and you're like, "Whoa, this is pretty nice." Target here was more like whatever they had like left over.
They didn't know how to deal with the Canadian.
No.
But so an example would be Target came out last week with terrible numbers saying that people are not buying stuff, and then the stock, like literally the stock went down 15%. Wow. Most of Wall Street would be like, "Oh my God, I'm selling." But the dividend passive income investors are like, "Hell yeah. I mean, that dividend, I'm still getting paid that dividend." And now the stock just went down a little bit, but that dividend is going to come back next quarter. They're not guaranteed, but they do it. So you don't have to stare. Like a lot of people like to look at the ups and downs, but I don't look at that. I just look at how much income am I making from my money, from my investments, because that's stable. That's a lot more stable than the roller coaster dividends, just like with real estate. So
that's awesome. That's awesome. Yeah. That's great. Now let's switch it up a little bit before we run out of time. It's it really sounds like you're super passionate about this. Every time I see your videos, you're really into it. And everybody that I've ever run across that's really been into what they do, they have a real strong why. So why is it that you do this?
Oh, so why? To be honest, I never thought I was going to go into finance. Okay. I hated numbers. But what happened was when my father sold his company 10 years ago, and he focused on one thing, he made it big, and then he sold his company, and he had a financial advisor. And then I realized that he was making more money by investing than by working his like job or his business. And for me, that's when like my aha moment came, and I'm like, why don't more people talk? And then I was 21. This was over 10 years ago. And I was like, this is so accessible to everybody. And so I just wanted to bring investing because it's how powerful it is, especially if you do it the right way, to younger generations, because the earlier you start, the better. And so I honestly do it because I want everybody to be able to retire early and not have to work a job that they don't like because they simply don't have that financial independence that they could have with investing, right? Like investing is just the most powerful passive income tool you could ever do. There's nothing more passive income than investing. And I think it's just so underutilized, especially in younger generation and especially in, Latin communities, Black communities, women, things like that. And so I just want to make more wealthy people more. I want to make everybody rich. That's
so basically, if I can sum it up. So you didn't go and watch Boiler Room and Wolf of Wall Street and decide to become a stock broker. You wanted to get into this and become a financial advisor to make sure that other folks build wealth. And at the same time, because you love what you do and you're satisfied, the satisfaction that you get from helping other people, you're also making money. Does that make sense?
Exactly. I mean, there's nothing better than making money. Amir, you would know, right?
It happens.
Like,
But I
losing
find
money is
that
the worst thing.
I find that it really depends on your motivation. And if your motivation is to help other people and you put the good out there, it comes right back to you. Versus like, well, I want to make a quick buck, so I'm here for for a couple of years, and then I'm in jail. So,
Yeah.
so if I think a lot of people get our industries, the wrong way. They think that, hey, you're not in a service industry, you're in a get rich quick industry. And I think that's why we have such a big influx of people into the business and then quickly out of the business.
Yep.
Right.
And you've probably seen it too with like real estate investing and things like that, where people think it's easy and then they realize that it's a lot harder. And if you don't have a purpose, like a why behind it, it's going to be impossible for you to stay the course. Impossible.
100%. Silvia, I could talk to you for another 2 hours about stuff, and I'm sure we'll talk again in the future. I want to thank you so much for putting all the stuff that you put out there for everybody to watch. Please go on Silvia's Instagram. We're going to put the link down below, so go ahead and check it out. We're going to put this in small snippets as well for everybody to watch. And if you have any questions, whether you're from Canada or Australia or wherever you end up watching this video from, reach out to Silvia. I'm sure she can be of fantastic value to you and your future investments. Thanks so much again, Silvia. We'll see you next time.
Thank you. Bye, Amir.
Bye.